Professional judgment in accounting impacts accounting estimates, and professional judgments and audits can impact the outcome of the audit and certification of financial statements. In this video, we'll discuss the importance of professional judgment in accounting and auditing, what it exactly is, the KPMG framework designed to help new auditors and accountants understand professional judgment, and common judgment tendencies that can impede professional judgment. What is professional judgment? Professional judgment is a key concept within the AICPA code. Professional judgment is influenced, though, by personal behavior traits, but a professional accountant should not allow bias, conflict of interest, or undue influence of others to override professional or business judgments. Professional judgment refers to the process by which CPAs make informed decisions based on their knowledge, experience, and expertise. It involves assessing and balancing various factors to arrive at a conclusion or recommendation that is in the best interest of clients, employers, the public, and the profession as a whole. Professional judgment is crucial in situations where there may not be a clear-cut answer or where multiple options are available. Under the AICPA Code of Professional Conduct, CPAs are expected to exercise professional judgment to uphold the fundamental principles of integrity, objectivity, professional competence, confidentiality, and professional behavior. This means that CPAs should act in a manner that is honest, unbiased, knowledgeable, and in compliance with relevant laws and regulations. While the AICPA Code provides general guidance on professional judgment, the specific application of professional judgment can vary based on the unique circumstances of each engagement. CPAs must consider the facts, the nature of the engagement, the needs of the client or employer, and the public interest. Very important, the public interest when exercising professional judgment. So keep in mind that standards and regulations may evolve, so it's important to refer to the most recent version of the AICPA Code of Professional Conduct or consult with a qualified professional for the latest information. KPMG, which is one of the big four CPA firms, has produced a framework intended to be used as a supplement in college-level auditing and accounting courses to help students understand the components of professional judgments and the threats to good professional judgment. The framework has been adopted as a professional resource by the Center for Audit Quality. The KPMG framework identifies 5 components of professional judgment that essentially mirror what we discussed in terms of ethical decision-making models in Chapter 2. The components are clarify issues and objectives, consider alternatives, gather and evaluate information, reach a conclusion, and articulate and document the rationale. Which means that auditors need to use System 2 thought processes. Auditors should approach matters objectively and independently, and it requires an objective attitude that includes a questioning mind, and critical assessment of audit evidence. One common judgment trap is the tendency to want to immediately solve a problem by making a quick judgment. Very common. This System 1 approach, though, ignores the more deliberate System 2 side of the process that critically analyzes the reasons for and against. In the real world, we may deviate from the process of analysis because, quite honestly, there are pressures, time constraints, and often limited capacity. These constraints, influences, and biases threaten good judgment. Our textbook gave an example of an auditor under time pressure who had received only copies of an equipment purchase invoice rather than the original and decided to forego asking for the original of the invoice due to time pressures. In this case, the auditor sacrificed sacrifice professional skepticism for expedience. In addition to System 1 problem-solving tendencies, there are 4 common judgment tendencies that are relevant and important for audit professions. The first one is the availability tendency, which may lead to judgments based on the easy accessibility of information rather than a deliberate analysis of how the facts of the current situation differ from the prior ones. Also, an auditor may rely on past procedures in the current audit, even though that approach may not be relevant to the current situation, or quite honestly may have been incorrect. Auditors always refer back to the prior year audit work papers to understand the process used in the past, and it's an easy trap, especially for new auditors, to assume that the prior year process was correct. In addition, information that is most available to an auditor's memory may also unduly influence estimates, probability assessments, and other professional judgments. The tendency for decision makers to put more weight on information that is consistent with their initial beliefs or preferences is the confirmation tendency. If the auditor expects a certain outcome and the audit evidence seems to prove that, then the auditor may stop looking. We see that confirmation tendency in other areas of our lives as well. The overconfidence tendency is when decision makers overestimate their own abilities to perform tasks or to make accurate diagnoses or other judgments and decisions, as may be the case when estimating outcomes or likelihoods. Having professional skepticism and being skeptical of audit processes and outcomes is important. Last, the anchoring tendency relates to starting from an initial numerical value and then adjusting insufficiently away from it, informing a final judgment as when the auditor becomes anchored to management's estimate. The audit of financial statements has always required auditors to exercise their professional judgment, but the use and importance of these judgments continue to grow as the overall complexity and estimation uncertainty inherent in financial statements increase. That is why audit firms have turned to developing professional judgment frameworks, such as this one provided by KPMG, to promote a rigorous, thoughtful, and deliberate judgment process to guide making reasonable accounting judgments.